It was the winter of 1930. Across America, ordinary people lined up in the freezing cold, not for food, but for their life savings. Banks were shutting their doors. Fortunes disappeared overnight. The United States, the richest nation on earth, was suddenly broke. This is the story of how the American banking system collapsed, why it happened, and how it reshaped the global economy forever. The 1920s were known as the Roaring Twenties, a decade of jazz, optimism, and booming markets. Factories produced more cars, radios, and refrigerators than ever before. Banks were lending freely. Ordinary people, teachers, farmers, even factory workers, started investing in stocks. Wall Street became a symbol of success. By 1929, over 600 new banks were being opened every year. But behind the glittering skyline of New York, the foundation was cracking. Banks were handing out loans like candy, often using depositors' money to gamble on the stock market. No federal insurance, no oversight, no risk control. People borrowed to buy stocks, and those stocks rose because people borrowed. It was a financial loop powered by greed. But when stock prices stopped rising, the loop reversed. In October 1929, the market crashed. In just 2 days, over $30 billion in value evaporated, more than the cost of World War I. After the crash, fear spread faster than facts. Rumors of bank failures led people to withdraw their savings. When too many people ran to get their money, banks simply ran out of cash, because most of that money wasn't there. Between 1930 and 1933, over 9,000 banks failed. Families lost everything. Homes, farms, savings. There was no FDIC, no protection. When your bank failed, your money died with it. Farmers watched crops rot because they couldn't afford to transport them. Factories closed. Unemployment soared to 25%. 1 in every 4 Americans was jobless. Bread lines stretched for blocks. Children sold apples for a nickel. It wasn't just a financial crisis. It was a psychological collapse. People lost faith in the very idea of money, and in the system meant to protect it. Then, in 1933, a new president took office, Franklin D. Roosevelt. His first mission, stop the panic. He declared a bank holiday, closing every bank in the nation for 4 days. Inspectors reviewed balance sheets, and only sound banks were allowed to reopen. It was radical, depositing their cash again. It worked. When banks reopened, something unexpected happened. Confidence, the invisible currency of any economy, was slowly restored. Roosevelt's New Deal introduced one of America's most important financial reforms, the Federal Deposit Insurance Corporation, or FDIC. For the first time, deposits were guaranteed up to $2,500. Later, much more. Banks were separated from investment houses under the Glass-Steagall Act. Commercial banks could no longer gamble with depositors' money, and the Securities and Exchange Commission, SEC, was born to police Wall Street. The government had finally realized confidence wasn't automatic. It had to be engineered. The great banking collapse didn't just destroy the U.S. economy, it rippled worldwide. Countries like Germany, already crippled by war reparations, saw their economies spiral. This global depression fed political chaos and indirectly paved the way for the rise of dictatorships in Europe. Financial failure became fertile ground for extremism. Every financial crisis since, from 2008 to the bank failures of Silicon Valley in 2023, carries the same DNA as the 1930s collapse. Overconfidence, easy credit, lack of belief that this time it's different. But history whispers, it never really is. The great banking collapse of the 1930s wasn't just about money. It was about trust, how fragile it is, how vital it is. Out of that darkness came the modern banking system we depend on today, a system built not just on gold or paper, but on the shared belief that tomorrow your money will still be there.